Welcome to This Week in Economics, WBRN Radio and on the Bostonred Network. This is the Numbers Man section, and as usual, we partner with Crescent Analytics to bring you the latest on the economy, the U.S. economy, and of course the international economy and how they interact. The Fed, don't have my calendar up here, but they will meet this week and decide if they will lower the interest rates. It's been estimated by some 0.25 or 25 basis points. We at this mic are not in favor of lowering the interest rate, and for the reason that it creates artificiality within the economy. There is hidden inflation within the economy. There's no doubt about that. And at the same time, the growth figure, the GDP figure coming out, is nominal for a modern industrial economy. I was just listening to a BBC report on Indonesia. Their GDP is about 6.1. They are a nation of the largest one in Southeast Asia, of over 250 million people, projected in the next roughly 10-20 years to be over 325 million people, the fastest growing economy in Southeast Asia. But the problem there is, and in many capitalist economies, income inequality. The top 20% make most of the money within the economy, or they occupy the head, and 80% of the people live in poverty. They have education problems there, and also they face the problem of automation. Automation is coming, and massive amounts of people will be made redundant or laid off. And that applies to industrialized capitalist economies also, that the automation pill has not, as they say, fallen, but in the next few years it definitely will become more of a reality, particularly in the U.S. in some sectors that involve transportation, as autonomous cars and trucks move in. The so-called haul services, Uber and Lyft, have ordered over 100,000 units of cars, or whatever you want to call them, that are self-driving or autonomous. This will be phased in, but one note here is that because the self-driving type of cars and trucks are software driven, and once you get a basic number, we'll say 100,000 out there, you could call it a beta, but the beta is already going on, and then it starts to mushroom. We have effectively a situation very similar to what happened with microprocessors, and the former chief executive of Intel talked about that and how they would double every few years. And that will actually occur. You will have doubling about 2.5 there as a double. You can expect that to happen after. And the beta itself, we're talking about autonomous cars and trucks, is a little bit different in that the data, or big data we'll call it, is already being collected. You now have various forms of driving assistance, and whether they park the cars, they have systems there that can look 2 cars ahead, or they can look behind, etc. All of that data is warehoused in huge warehouses, and it can be accessed. So you're not just looking at the data that would be mined from the large betas of 100,000 cars or so out there from day one. You're looking at it from now and several years before now. The Tesla cars are an example, but that's just a small set. If you go to the cars that are manufactured by GM and Ford, they have their own systems that they also use. But this all goes to one central data depository, one or two. And these are huge, and these things tend to be across the 50 states in the U.S. and various other places. And this goes 24/7. Now, there are the pilot projects that are all over the U.S. and Canada, many of them in the U.S. in the West, involving long-haul trucks, involving cars in Arizona, California, and various other weather conditions. Now, those will affect that part of the economy. But at the same time, you have the Amazons of the world, where workers are literally working with the robots, as they are called, and the robots are cleaning the floors at the Walmarts of the world, and they're there with the workers, and there will be more of them there taking care of these routine tests. You'll have such things as trains will be automated. They are automated in Japan, across Europe, and much of the world. So you will see more of this, and those jobs will be made blank. Let's move to our presentation here. A headline from Reuters. On the 26th of July is the date post. The headline is U.S. economy slows in Q2, a second quarter weak business investment, a red flag. Well, that's been talked about before. The U.S. economy showed less than expected in the second quarter as a surge in consumer spending blunted some of the drag from declining exports and a small investment bill, which could further bring about a concern to help the economy. But the fairly upbeat report from the Commerce Department on Friday had some red flags for the 10-year-old growth expansion, the longest in a record. For the first time in more than 3 years, housing declined for 6 straight quarter. That would mean housing is in a recession. The chair of the Fed, Chair Powell, earlier this month, flagged two sectors as the weakest. The economy is likely to provide additional cover for the Fed. This is next Wednesday. For the first time in a decade, because of rising risk to the economy, look for a bitter trade war between look out for China and U.S. slowing of global growth. That has been a situation that the key to future economic growth is business spending. Evidently, businesses do not share the endurance of the consumers. That is from Sung-Wan Su, an economist, professor at Loyola Marymount University in Los Angeles. I've worked with him before. This is not a good sign for the economy because there will be fewer jobs for consumers. For this reason, the Fed will cut rates next week. He thinks this is widely expected to cut its the Fed, that is, a quarter of a point, 25 basis points. The GDP increased at 2.1% amortized rate for the second quarter, stepping down from an unrevised 3.1. That is a point. That would be the January to March period. Economists polled by Reuters had forecast GDP to increase at 1.8 rate in Q2. They estimated the speed at which the economy could grow over a long period without igniting inflation as between 1.7 and 2% here. Revisions to growth data, and we'll get into this in a minute, published by the government, also confirmed the economy missed a target. And this was very unrealistic of 3% in 2008, growing at 2.9%, which measures a year-on-year basis. The economy only expanded at 2.5 instead of 3% as previously estimated. you'll find that this happens in all administrations. There's a certain rah-rah effect that gets into the data, and then it has to be revised. Economists who are forecasting growth this year of about 2.5% said the massive fiscal stimulus, which included the notorious 1.5 trillion package, has no lasting effect on growth while driving up the debt. And that is something that many in the economic sphere had talked about. The data makes one thing clear, that tax cuts do not result in permanent upshifts in a growth path for the U.S. economy. That's from Joe Basuris, the chief economist at RSM in New York. GDP report showed a pickup in inflation last quarter, and that is well below that. But again, that is a judgment. One thing to remember about inflation sometimes is hard to measure because, first of all, the volatile sectors, food and energy, are not there, but energy cost is down, so that is one of the things we really don't need to worry about. Spending is being supported by lower unemployment rates in 50 years, helped offset some of the weakness from exports, which fell 5.2% last quarter. Plunge in exports led to wider trade deficit, which has subtracted 0.65% from GDP last quarter. Trade contributed 0.73% in January to March. Robust consumer spending helped businesses to whittle down inventory overhang. Inventory investment increased at $71.7 billion rate, slowing from the first quarter. It was 116 billion pace of increase. The inventory is cut at 0.86 percentage points of GDP. Cut that from the GDP. Second quarter after adding 5.3 in Q1. Business investment fell, and all the PCIs indicated that that's what happened. 0.6 percentage rate in Q2, the first contraction since the first quarter of 2016. It was pulled down by 10.6% decline in spending on structure, depressed by decreases in commercial, healthcare, mining, and exploration shifts. Business spending on equipment rebounded at 0.7%, but it seemed constrained by design problems at Boeing's, and they're still there. Boeing's reporting its biggest ever quarter loss on Wednesday due to sprawling costs of resolving issues with its 737 MAX. Growth in government investing accelerated, notching its best performance in 10 years, but spending on home building contrasted for the sixth straight quarter. The headline in the BBC was U.S. economic growth slowed below the target of the Trump administration, and basically the same thing. They had talked about 3%. The problem with these types of forecasts, very optimistic forecasts, and there's also a possibility here. A revised figure showed that GDP expanded at 2.5. That is reasonable for an economy at this stage of the game. And remember the massive tax cut. And what that does is, we used to call it pump priming, adds a certain amount of artificiality. You normally don't do that type of tax cut unless it is warranted. Usually that is when you're in a recession. You can do tax cuts to stimulate things such as, it's not parallel. Well, the Reagan tax cut was a little bit different. You have to remember that the economy was much smaller in the 80s than it is today in the 2019. And they also mentioned the 2.8 expansion forecast. Well, You have to look at that estimate, 2.8% there, and there could be further revisions. Nancy Cuyton, she's a chief investment officer at Close Brothers Asset Management, said growth has come off of the boil in the U.S., but investors should not be too downbeat. It beat expectations. Well, what you do is you lower expectations, and that's a trick. And then at the same time, if you say 1.8 is what we expect, and you come in the twos supposedly, but that is a trick there. Period. While slower growth reflects the global impact on ongoing trade tensions, export slowdowns, the labor market, and productivity improvements have proven a bright spot. Well, that bright spot will not continue, and this is what we talked about. And let's see, Neil Wilson, he's chief market analyst at markets.com, said that interest rates cut by the Fed next week, was more likely to be fine-tuned rather than starting an easing cycle that involved severe cuts. A number of conservative commentators continually criticized the accommodation of quantitative easing under President Barack Obama. So in other words, that is nothing new going on there. Now let's go to Alphabet, and then we'll get actually into the government's figures here. Alphabet is, of course, the parent company of Google. And this is also on the 25th. Alphabet and Amazon rake in higher revenues. Advertisers were spending more on its search and YouTube services. However, Amazon reported profits were below than expected as it invests to speed up delivery times. Well, that would be an interesting situation, which is shift away from buying and selling products itself and focus on the role as a marketplace. That's sort of an eBay type of model. Reported revenue for the last quarter at $63.4 billion, and that would be $51 billion and 51 billion pounds. Consumers responded to Prime move to one-day delivery. Well, that's more like going to a retail store, and of course you can get it instantly there. The profits for Amazon at $2.6 billion were below expectation. Well, expectation was too high. After-tax profits at Alphabet, the firm, of course, that owns YouTube and Google, tripled compared to a year ago at $9.9 billion, beating the so-called analyst expectations. Alphabet's revenue rose at 19% compared to a year ago at $38.9 billion. The chief executive of Google said both its traditional service and new technologies, and again, this is not anything new. We started doing AI research in 1989. Anyway, but strong financial performance comes at a time when regulators, of course, are beaming in on these characters. Much of this is done is accomplished by dodgy processes. Brussels launched an investigation into whether Amazon's use of data in the marketplace breaches the EU competition rules. The Department of Justice in the U.S. is also there on the scene. Now let's go to some of the actual figures here. And this is a release here on the 26th of July. Income and national products accounts. This is a gross domestic product for the second quarter, the advanced estimate here, and annual update. Gross domestic product increased at 2.1% in the second quarter, according to the advanced estimate from the Bureau of Economic Analysis. In the first quarter, real GDP increased 3.1%. The Bureau's second quarter advanced estimate released today is based upon source that are incomplete and subject to further revision there. And the second estimate for the second quarter, based on more complete data. That'll come out on the 29th of August. The deceleration in real GDP in the second quarter reflects downturn in investment in inventory investment, exports, non-residential fixed income. The downturn were offset by acceleration in PCE and federal government spending. Now, the problem with federal government spending is, in many cases, it provides against certain artificiality. The price index for gross domestic purchases increased at 2.2% in Q2, compared with 0.8% in Q1. The PCE index increased by 2.3%, compared with 0.4%. Excluding food and energy, the PCE price index increased by 1.8%, compared with 1.1% in Q1. Current dollar personal income increased at 244.2 billion in Q2, compared with an increase of 269.8 billion in Q1. Decelerations in compensation and personal current transfer receipts were partially offset by upturns in personal income receipts on assets, and a deceleration in contributions for government social insurance, a subtraction of the calculation of personal income. Disposable personal income, something we watch very, very closely here, increased by 193.4 billion, or 4.9% in Q2, compared with an increase of 190.6, or 4.8% in Q1. Real disposable personal income increased at 2.5%, compared with 4.4% in Q1. Personal savings rate was at 1.32 trillion in the second quarter, compared with 1.37 trillion in Q1. Personal saving rates, personal savings as a percentage of disposable income was 8.1% in Q2, as compared with 8.5% in Q1. Now, these are some updates from the first quarter. Real GDP is estimated to increase 3.1%, the same as previously published. Down revisions to export, state, and local government spending and private investment inventory were offset by revisions to PCE and government spending for the period of expansion from the second quarter of 2009 to the first quarter of 2019. That's 10 years. Real GDP increased at an annual rate of 2.3%, the same as previously reported. Real GDI is estimated to increase at 3.2% in Q1. And looking at some charts here, the previous estimate of real GDP is 3.1, revision is at 3.1, and real and current dollar GDP at 3.8 was the previous estimate. 3.9 is the revised, and real GDI previous estimate is at 1, and now revised at 3.2. The average of GDP and GDI was previously estimated at 2.1. Now the revision is 3.1. Real domestic purchase index at 0.8, and revision was also 0.8. The PCE price index at 0.5, and now it's 0.4. It has dropped for that particular situation. We did have state by state here, and I'm guessing now this actually is for the first quarter. We'll just look at it a little bit here. I don't know if we did this last week or not. Maybe we did. Anyway, this is gross domestic product by industry. This is Q1. Finance, insurance, retail, trade, healthcare, and social assistance were the leading contributors to increasing U.S. economic growth. That was in the first quarter. According to gross domestic product by industry statistics, 16 of 22 industries contributed to the overall 3.1%. Finance and insurance groups' real value added, a measurement of their contributions, increased by 9.5 in the first quarter after decreasing 6.2 in the fourth quarter. First quarter primary growth primarily reflected increase in insurance carriers related activity. Retail trade increased to 11.9 in Q1 after decreasing at 2.5 in Q4. Healthcare social assistance increased at 6.2 after increasing 6.4. It's the largest increase since the fourth quarter of 2008. That was the beginning of the Depression. Other highlights: non-durable good manufacturing increased at 8.4% in Q1 after increasing at 1.1% in Q4. Information services increased at 4.5% after increasing 8.1%. That would be in Q4. First quarter growth primarily reflects the increase in data processing, internet publishing, and other information services, as well as publishing industry. Education services increased at 4.3 after decreasing at 4.1. Economy-wide, real gross output, principal measurement of industry sales and receipts, which includes sales to the final users, that is GDP. Sales to other industries, intermediate input, increased at 1.6% in Q1, reflecting an increase of 2.8% in private goods producing sector and 1.3 for private services producing sector, and 0.3 for government sector. Real gross output for information services at 4.7 in Q1 after increasing 5.3 in Q4. Slow down there. Finance insurance increased at 4.2 after increasing at 5.1. You can see some slowdowns coming here. Healthcare social assistance increased at 7.1 after increasing at 4.7 there. A little bit better. And the next update here will be on the 29th of October 2019. We would run this out here and really if we look at such things as agriculture, 2017 they were a minus of 4.8, and in 2018 this is agriculture, forestry, fishing and hunting at 4.1. We'll just look at a few of these. Construction in 2017 at 0.8, and in 2018 at 2.9. A little better there. And the federal government at 0.3 in 2017, at a negative 0.4 in 2018. State and local government was down here. So looking at some of these percentage changes here from. We won't get into these. I'm not sure we'll put this on or not. This is an older. We had a state-by-state summary, and for some reason it had slipped away from us. And let me see where we are here. Okay, let's do some of the market data here. You get a little benchmark over the weekend, and we'll. The FTSE was at 0.95%. That's the FTSE 100. And in Amsterdam, they were at 0.94%. In France, at 0.46%. The DAC in Frankfurt was at 1.18%. The Eurostras was at 7.8%. And in Madrid, they were at 7.9. So actually, we couldn't do it this way, I suppose. Yeah. The change was for the FTSE 100 at 44.68. For the in Amsterdam was 5.39. In France at 25.82. There's different ways of looking at this. And in Frankfurt, they were at 144.41. And the Eurostas was at 27.3, and in Madrid they were at 72.8. The Dow was at 17.70. The Nasdaq was at 57.65, and the S&P 500 was at 8.42. A little different here in Bombay. They were in the negative 21.03. Hang Seng was at 95.22. And the Nikkei at 204.09. And you can put that down there. And the euro was at 1.11929 dollar there on change there. And let's see, what else do we have pushing up here? Brent crude futures were down 0.11% or 7 cents there at $63.19. West Texas crude, T-Boone Pickens still jumping for joy in his retirement, was at 56.22. Gold was down 0.88% or $12.60 change at $1,424.45. That's on the Forex. And what else do we have? That is our commodities wise and not so wise situation there. And let me just check here. What we don't have this time around, we had state by state here. We'll have to throw state by state in as we do sometimes here later in the ball game. Let me just jump over the bond, the 10-year Treasury, 2.076 in the U.S. This is from Reuters, incidentally. We don't have anything else here. And yeah, trying to do a little bit of a roundup here. T-Mobile wins U.S. approval of $26 billion. They won antitrust approval to take over rival Sprint. So now we have one less carrier in the U.S. to deal with. Twitter shares jumped 10% on solid revenue growth there. And basically, I suppose the way they summed it up here, Alphabet, Starbucks pushed the S&P 500 up, and the Nasdaq to record highs. Don't count on that. How long these will stay up? Dish Network. This is all from Reuters here. A bid to become the fourth U.S. mobile carrier may cost $1 billion more than expected, pitting it against giant corporations, but satellite TV producer has an advantage with fresh start with no legacy technology to maintain deep pockets partners. So they're trying to be a mobile carrier too. You're going to see increases in the space. It will continue to increase. There's no doubt about that. So this is one of the things you're going to see out here with these carriers, the mergers of Sprint, etc., all merging together to have one big happy, maybe not so happy state here. Brexit, we didn't say anything about it. Boris Johnson's now the Prime Minister in the UK. He is in his cohorts in favor of what they call a hard Brexit. That would be a no deal there. We don't know about the Irish backstop. This is the Irish Republic in Northern Ireland. Now, they will continue to have access as far as the border, but when it comes to trade, there will be a problem there. And in the UK, people are starting a problem. Period. It is one of those situations that we see, and in the UK, the whole Brexit thing was part of a populist trend there with the Conservatives, the Tory party, and you had to leave and you had the Remains. It came out at 3 or 4% spread between the two, and the controversy now is, will they have new elections, or will the UK just have a leave and that will be it? Will they pay the bounty to the EU? How firm will the EU be? Will there be any more negotiation? You remember the former Prime Minister, Theresa May, tried to do that, but there was no appetite for it in the Parliament. So once again, we have a situation that's a bit unusual in that you could have a number of outcomes, a lot of uncertainty in the UK economy. Will the UK just have elections? They could have snap elections, and then the Labour Party would play into that, and also the UK economy. Now, we didn't cover the UK economy. We will get them the next time around and look at where they are going. They're not performing as well. We'll have some PCIs in our next broadcast coming next week. A little late here. We'll have attempted to have much more inconsistency with our report. A little over a week here, but reporting the major things. Again, the Fed will meet on Wednesday, and they will make a determination on an interest rate decrease, 25 basis points. This is one of the point is an ominous opening that the U.S. economy is not performing well. Now, the problem is 25 basis points, which we do not favor, decrease in interest rates would not be as catastrophic, but if they continue this, we enter something called negative interest rates. We've talked about it before, and that is the gateway to deflation, and deflation is much, much more difficult to deal with than inflation. So this is a problem within itself. As if you look back, since this administration has been in office, you continue to have artificiality in the economy, such as some job owning there to keep factories going when they normally should shut down, and some other things happening. You can only do that for so long, and then the bottom falls out. But in a modern, globalized, capitalist economy, the bottom could fall out in Britain, which is a chain reaction. We also have some problems in Italy now, and in some other countries as far as where they are in terms of their growth. Brazil, you look at it, on the Bolsonaro, it's become a basket case there. And the whole problem of immigration to the U.S. Now you have Guatemala as a third country. In other words, immigrants would stop there and apply for citizenship first, but there are no facilities to deal with that. They're also using Mexico as one of the stopover points. But the problem is you don't have the basic problem of immigration, which causes hundreds of thousands, millions of dollars, and you have a declining labor force, where the baby boomers are some holding on for financial reasons, many, and at the same time you have a situation, a shortage in some basic skills. And then you look at your whole training system from secondary, your traditional technical, we used to call technical type schools, and universities to bring their offerings up to date. More online offerings there than ever before. Looking at 3-year programs, 1-year programs. We have 1-year programs around for 50 years. I mean, there's nothing new there. But what you have is you have a global economy. At the same time, you have an increasingly technical-based economy on knowledge work. Now, knowledge work is totally different. If you look at the Gates and the Facebooks, the Alphabets of the world, the money made there was from knowledge work. And of course, it's based on consumer ads. The problem is that the consumers in various countries slow down their buying. The show is going south, so to speak. Not a very good economic term there. So that's something to look out. You just simply cannot maintain of these situations. Under President Barack Obama, the economy came out of a depression, and then it started to grow and started to grow. But the nature of capitalist economies, you can provide only so much artificiality. Now, an interest rate decrease will provide something for investors, but we caution people to be very, very careful with these mergers here, what will happen there, and where the consumers will go. For those in business, make next week a productive one. For the consumer, obviously keep your eye on the ball. This is MA from Cranston Analytics, and the episode is This Week in Economics on the 28th of July, 2019. See you next week. Good day.